Hello everyone, welcome to today's webinar brought to you by Trade in collaboration with Busan, Malaysia. Today's our title is Kenanga Oil and Gas Sector Outlook, Understanding the Fundamentals of Black Gold. All right, so today we are going to delve deeper into the outlook for the oil and gas industry. Before we start this webinar, may I share with you a little bit about a CSR project that is undertaken by Kenanga Investment Bank that is titled Meals That Give. So for this campaign, Meals That Give, Kenanga would like to ask any kind souls here, if you want to pledge a meal at 20 ringgit, so you may join Kenanga in championing this cause. For every meal that you pledge for 20 ringgit, Kenanga will match meal for meal. All right. So for every 20 ringgit donation that you give to this cause, Kenanga will match another 20 ringgit. So what will this proceeds used for? So this proceeds will use to sustain employment opportunities for the disabled employees at Cafe Includes. All right. And it also provide training and development to the disabled employees at Cafe Includes. And for the meal that you pledge, right, it will give out to the children in need for 3 rumah kebajikan. All right. So if you want to join this campaign, if you share the Kenanga cause in championing this to help disabled employees in Cafe Includes, you may scan the QR code here on the right hand side corner. All right, and then it will take you to the fundraising campaign. That's where you can make a donation as little as 20 ringgit. All right, so thanks for joining this session that is titled Kenanga Oil and Gas Sector Outlook. As usual, disclaimer. So whatever we share in this webinar is only for educational purpose. So in no way that I give any recommendation for you to buy or sell any listed companies that should be mentioned here. So if you decide to make any investment decisions, you are 100% responsible for all your investment risks. All right. So today we are very humble and honored to invited the senior equity analyst from the Kenanga Research, Mr. Stephen Chan, to join us in this Kenanga Oil and Gas Sector Outlook to talk about the fundamentals of black gold and its outlook. All right. So ladies and gentlemen, please help me to welcome Mr. Stephen Chan. Stephen, thanks for joining us.
Hello. Hi, everyone. Hi.
Yes, can hear you.
Yes.
Looking good.
Yeah, hope everyone can hear me. Yeah.
Yes, can hear you.
Right.
All right, you may go ahead and share your screen.
Okay, sure. All right. Yep. Good evening, everyone. So the oil and gas sector, I understand the oil and gas sector can be quite a complicated sector, quite a challenging sector to understand, right? There are many macroeconomic factors involving that impacts oil and gas. There is many geopolitical factors that impacts oil and gas, and I think some of you investors, have noticed how come some oil and gas counters move and some oil and gas counters don't move, right? So it is not one of the easiest sectors to understand. I admit that, and I think throughout this seminar that we have this evening, hopefully by the end of it, you guys have better understanding of the fundamentals of oil and gas. What are the drivers that move oil prices? What are the drivers that impact stock prices as well, and which stocks would move under what conditions, which stocks would move under what conditions, that so on and so forth, right? So without further ado, I'll kickstart my presentation. The table of contents. What are the topics that we're going to cover tonight, right? I think we'll start off with the history and overview of crude oil prices. Where did we come from, and where are we today? And as you all know, current oil prices are very high. It now is hovering above $100 per barrel, and we also take a look into what is the key factors driving the current high oil prices. We'll discuss on the long-term relevancy of oil and gas. We'll take a look at what is our oil price outlook, as well as the sector overview and outlook. And of course, we will wrap up with some of our stock picks as well. Right. Just a brief history on oil prices, right? If you look at this chart, we started off last decade, right? Mostly in 2011, 2012, oil prices were hovering steadily well above $100 per barrel, all right? So back then, you know, it was the good old days. Moving to 2014, there was an oil price crash, right? And this oil price crash was mainly attributed to the emergence of shale oil, and the reason being is mostly because of technological advancement that brought down the break-even prices of oil at that period of time. OPEC started to limit productions somewhere early 2016, and that at least put a floor to oil prices, right? And for the next few years, we see oil prices being a bit more steady. The second crash over the last, let's say, 10 years or so, came from the COVID-19 pandemic. So the first half of 2020, right, oil prices crashed down. I think Brent down to as low as 20, and if you look at WTI, it actually went down to even negative territory. Again, OPEC came in and limited productions, and that at least put some support for oil prices as well. And as you all know, earlier this year, there is a full-scale Russian invasion of Ukraine, right, which further drove up oil prices to $100 per barrel to what it is today, right? So this is just a quick overview of the history of oil prices, right? Just zooming in on the first oil price crash, right, of 2014, right? Why did oil prices crash back in 2014? You can look at this graph. This graph essentially shows the average break-even price of oil throughout the years, right? It started off 2013. The average US shale break-even was above $70 per barrel, right? As technological advancement continues to improve, right, the break-even prices of US shale has been gradually brought down, and until when you reach towards the end of 2016 or 2017, it was as low as just above $30 or even $40 per barrel, right? And because of this, during this period, we saw an emergence of US shale oil, right? US shale oil, and this is a graph showing the US crude oil production over the years, and you can see also roughly around this period, right, in early 2013 going into 2014, the production of US crude oil has just suddenly shot up because of the cheaper break-even price of the US shale, and this basically drove the oversupply in the market back here in 2014, right? Which driven the first oil price crash over the last 10 years or so, right? And if you look at the breakdown of oil producing countries in the world, US is actually the biggest oil producing country, right? It contributes about 20% of global oil production, right? OPEC en bloc, meaning as a group, as a coalition, they are the largest oil producers. But of course, this is not a single country. This is a collection of multiple countries, right? So that's why when we are looking at oil prices, we always see what OPEC is trying to do. Whether are they trying to increase production? Whether are they trying to limit production? And the reason being because OPEC being the largest oil producers in the world en bloc, whatever they do has a significant impact towards the direction of where oil prices are going, right? If you look at former Soviet Union, it's about 13% of global oil production. Of course, former Soviet Union includes several other countries aside from Russia, right? So Russia alone contributes about roughly 11% So the other countries, let's say about 2%. So just bear that in mind. Russia is about 11%. OPEC is the largest, and as a country, US is the largest crude oil producer in the world, right? If you look at the breakdown, you might be curious, where does Malaysia stand? Malaysia contributes roughly about 500,000 barrels per day production. So is less than about 1% of oil production, global oil production, right? Just a breakdown of the oil producing OPEC countries, right? OPEC, as you recall, OPEC is the largest oil producing coalition. As a coalition, OPEC is the largest producing oil producing in the world, right? If you look at this, Saudi Arabia, of course, by far is the largest. Hence, OPEC tends to follow. Saudi is like the big brother, right? So OPEC tends to follow the direction of what Saudi is trying to do, because it exerts a huge influence towards the other members of OPEC, right? The other notable ones are Iraq, Iran, UAE as well. All right. What is driving the current high oil prices, right? Of course, the main reason for the current high oil prices is the Russian invasion of Ukraine, which caused high uncertainty in oil supply, right? And as I mentioned earlier, Russia makes up of roughly 11% of global oil supply. It supplies roughly about 25% of the Europe's oil and 40% of the Europe's gas imports, right? So Europe is very, very reliant on Russian oil and Russian gas. And hence why the invasion has actually caused a very, very high uncertainty in where these supplies are going to come from going forward. In combination of these factors, OPEC also has been very, very slow to increasing output, either through reluctance, probably politically driven, but also mainly because of underinvestments over the past 2, 3, 4 years, right? Because of these underinvestments, there is a lot of OPEC capacity that is currently deemed inaccessible because they have been very under-maintained over the last few years, and the sudden ramp up of production by OPEC has been rather challenging, right? Of course, in a post-pandemic era, as we transition to an endemic phase of COVID, right, there is a steep recovery in demand as well. And this has driven crude oil inventories to a low. And low crude oil inventories tend to amplify the potential of oil price volatility, and hence why it drives up the higher prices. And I think we just take a deeper look into a few of these points here. If you look at the demand of oil and gas, crude oil going forward, right? Pre-COVID, pre-pandemic, demand supply roughly balances out at about 100 million barrels per day. Okay, during the peak of the pandemic in the first half of 2020, oil demand actually dropped to as low as 56, 57 million barrels per day. Then we see a V-shaped recovery, right, all the way until today. And going forward, if you look at the demand forecast, this is given by the EIA, the demand forecast, it looks like 2023's demand is expected to actually exceed pre-COVID levels, right? And the strong increase in demand over the last 12, 18 months has actually led to an aggressive stock draw, meaning to say that the inventories have been aggressively drawn down to fill this demand over the past 12 months or so, right? And therefore, you see a sharp decline in global crude oil inventories over the last year or so. And as I mentioned earlier, lower crude oil inventories typically breeds more potential for oil price volatility. And if you look at based on the increase in production, right, and the increase in demand, yes, there will be a gradual build-up of inventories over the next 1 or 2 years, but it is still below the 5-year average, pre-COVID 5-year average, the average from 2015 to 2019. So I think that the conclusion of this slide is that for the next 2 years, crude oil inventories globally will still be at a low, hence which again breeds volatility, right? If you look at the European countries that are reliant on Russian oil, right, you can see some of these names here. I'm not going to list it down, just as a reference. The countries that are reliant on Russia's gas exports, right? So Germany is one of Russia's Russia's biggest customer before the Russian invasion of Ukraine, right? So Germany, I think based on latest statistics, Germany before the war was, I think, about over 50% of Germany's gas came from Russia. And just to recap, roughly about 40% of total Europe's gas actually came from Russia, right? And if you look at which countries are still buying fossil fuels from Russia over the last couple of months, even after the war, even after the war started, right? Which are the few countries that are still buying? Of course, China is number one. Germany is still aggressively buying, right? Because then, as I mentioned, Germany was very reliant on Russian oil and Russian gas. Italy is still buying as well. Netherlands, Turkey. So a lot of European countries, even after the war had started in February, over the last 4 or 5 months, right, they are still buying fossil fuels from Russia. And I think this is a very important point that I think I will further elaborate later on. If you look at the reductions of countries over the last couple of months, right? This is the May numbers versus the February to March 2022 numbers, right? Of course, US has no longer buy any import from Russia. Sweden is also almost eliminated everything. But you see that there are not many European countries. You see, Germany is way down here in 8%. So ever since the war started, right, as of May, right, it has actually only Germany's import from Russia has actually only gone down about 8%. Netherlands about 5%, and I think this is a very important point as well. Again, I think if you look at OPEC's production level, as I mentioned earlier, OPEC has been very, very slow in increasing its demands, even increasing its production, even despite the high oil prices, right? If you look back in 2018, 2019, OPEC tends to produce about 37 million barrels per day. And this is according to EIA's forecast. EIA is expecting OPEC to actually cap out at about 35 million barrels per day, right? Going into 2022, 2023. Hence, they are still very, very slow in increasing their productions. If you look at OPEC's spare capacity in total, right? Because of the slowness and reluctance of them increasing production, right? You see, in 2022, 2023, the spare capacity is still high, and it's still very much higher than 2015 to 2019 average levels. That this is the 5-year before the COVID pandemic. It is still a lot higher than the 5-year average, right? And I think, as I mentioned again just now, this is mainly because of the lack of investments, the underinvestments that have occurred over the last 2 or 3 years, which has rendered a lot of these spare capacities from OPEC to be inaccessible, right? And so to bring these spare capacities into the market might take slightly longer. Right. So the oil price outlook, assuming status quo, and I think we have to establish some sort of a base case assumption here. So status quo meaning assuming that the Russian-Ukraine war continues to go on. We assume that China, under its COVID zero policy, gradually improves, borders gradually open, assuming all this status quo, this is our base case assumption. Oil prices are expected to stay elevated throughout 2022 and 2023. So basically what we're saying is oil prices are expected to stay above $100 per barrel for at least the next 2 years, assuming the status quo. We at Kenanga Research, actually, we are looking at a Brent crude price assumption of about $110 per barrel. So as I said earlier, well above $100 per barrel, right? And this is driven by the increase in oil demand, especially going into 2023, right? As China recovers from their COVID lockdowns, I think this month we have seen Shanghai gradually has been loosening its borders as well. And I think the huge, one of the biggest drivers of oil demand going into 2023 is that with the assumption that China would gradually ramp up their demand. And with the higher demand in 2023 to even surpass pre-pandemic levels, we believe that the supply side may struggle to keep pace, right? The sanctions on Russia is expected to increase, to tighten over the next 6 months. And the EU countries have also agreed to ban 90% of Russian crude and oil products, over the next couple of months. And if you recall the slide that I shown earlier, a lot of EU countries are still buying Russian oil for the last 4 or 5 months. And so over the next 6 to 8 months, this supply to EU basically will be erased from the market, about 90% of them. So that combined with the stronger demand, especially from a resurgence of China, we believe it's expected to hold oil prices above $100 per barrel over the next 2 years. All right. Is oil and gas still relevant in the long term? I think this is a very important topic that we should touch on. Yeah, because if you don't think oil and gas is relevant, then I think there is no point looking at the sector, right? And I think that over the last few years, the emergence of cheaper and cheaper renewable energy. You have seen news, Tesla cars, electric vehicles, and whatnot, right? So there is a lot of argument that whether or not, over the long term, over the next 30, 50 years, are we still going to be reliant on oil and gas? If you look at this graph is a long-term projection of energy consumption by fuel. And basically what this means is that by 2050, we still foresee that oil and gas or petroleum and natural gas will still remain the most consumed source of energy from now until 2050, right? Renewable energy, which is this green line here, will be the fastest growing source of energy, but oil and gas will still remain the largest. So I think that sort of answers whether or not oil and gas will still be relevant over the long term, right? This is basically another graph from a different source, driving home the same point, right? 2050, if you look at the green color, which stands for crude oil, dark blue stands for natural gas. By 2050, it will still be the largest source of energy, right? Of course, demand for oil and gas gradually will decrease because some of this market share will be taken up by renewable energy, like solar PV, wind. But as a percentage, oil and gas, by 2050, we expect to still be the largest energy supply. If you take a look at what are the main uses of oil, the main uses of the biggest use of oil by far is actually transportation. So your cars, your aeroplanes, your lorries and whatnot. And of course, industrial as well. This graph, basically the same point, until 2050, transport would still be the largest driver of oil demand in the world, right? And if you take a look at EIA's projection of light-duty vehicles sales by technology from now until 2050, you can see that battery electric cars is expected to increase its market share, I think almost tripling from today until 2050, right? but by and large, even up to 2050, according to EIA's projections, most of the light-duty vehicles, most of the cars sold will still be gasoline-based, right? So by 2050, I think there is still a very, very strong demand. There's still a very relevant need for oil. If you take a look at gas is mainly used for power, right? For electricity. So throughout 2050, power stations will be the biggest usage of gas. Buildings, manufacturing are second and third, right? And even if you take a look in Malaysia, this is a chart actually I've gotten from the Energy Commission of Malaysia. So this is in Malaysia. By 2039, gas will still contribute about 47% of our electric consumption, right? Of course, renewable energy, this green bar here, will gradually increase its market share, but gas over the long term will still be relevant for power production, right? So I think the last few slides, I think what I was trying to express is how relevant oil and gas is, despite the rising demand for renewable energy, how oil and gas are still relevant over the next 30, 40 years, right? Now, we take a look at how the oil and gas industry operates, right? Generally, if you look at the oil and gas value chain, we divide it into three sections: upstream, midstream, downstream. Generally, when people say upstream, it refers to activities that involve exploration, production, development of oil. Midstream, generally, it refers to activities that include transport and storage of the oil. And downstream is the refining, the marketing, the sales, the distribution part of the value chain, right? And how does the Busan listed companies fall into these categories? We take a look. Now, under upstream, I'll just run this through one by one. Under upstream, we have fabricator names, right? So fabricators are essentially EPCC contractors, right? They're basically construction companies, right? So like companies like Sapura, like MHE, what they do is they construct all these offshore platforms that are used for the production of oil and gas out in the open sea, right? Exploration and production, we have Hibiscus. Hibiscus is I think the largest Busan listed E&P. E&P stands for exploration and production, E&P company. So what Hibiscus is essentially they are a producer. They are the owners of the oil field. So they own the oil field. They explore for new oil. They develop. They produce the oil and then they sell the oil, right? So this is what Hibiscus is doing. Well service providers, we have USMA, Dilium, T7, Reservoir Link. These are basically service contractors that help E&P players such as Hibiscus, such as Petronas, to do all sorts of brownfield activities. We call it brownfield activities. So, for example, like well enhancement, production enhancement, plug and abandonment, these sort of works. Drilling rig providers, we have Velasto and Sapura. Velasto mainly does jackup rigs. So Velasto is actually the largest jackup rig provider in Malaysia. Sapura mainly does tender rigs, so they are slightly different. OSV providers. OSV actually stands for offshore support vessels. We have several. We have Alam, Perdana, Icon. Pipe players, we have Hwaseong, Pentec. So Hwaseong does pipe coating. Pentec does pipe fabrication. Fpso providers. So Fpso stands for floating production, storage, and offloading. So FPSOs generally it tends to be a huge, large-scale project. So typically, one FPSO could cost about 500 or even 1 billion or even 1.5 or even 2 billion US dollars to construct one FPSO. So FPSO is a huge infrastructure kind of project. Usually, FPSO providers, when they provide an FPSO to their clients, the nature of the contracts are long-term, so as in like 10, 15, 20, 25, 30 years sort of contracts, right? And for a lot of oil fields that uses FPSO in their build-up, usually the FPSO is one of the most integral part of the production of the oil field. Midstream, we have Dialog oil storage, right? A Dialog is they mainly operate in Pengerang. They do the oil tankers where a lot of the oil traders store their oil in Pengerang. MISC is a shipping company, so they do petroleum shipping, LNG shipping that transports oil. So these are all midstream. Downstream players, we have the offshore maintenance or topside maintenance players, includes Dayang and Charimin. We have the onshore EPCC and maintenance providers. So these guys provide onshore maintenance. These guys provide offshore, right? Your offshore platform maintenance guys are players like Dayang. Players like Sabah, like Dialog, they provide onshore. So like your refineries, like your Pengerang site, right? So what these guys are the ones that actually provide the maintenance works. Petrochemical players, the two largest one in Busan, Malaysia is PChem and LC Titan. Distributing and marketing, we have PetDeck, and PetDeck is essentially the Petronas petrol stations that you see on the street. Refineries, we have Hengyuan and Petron. So I think through this graph, I hope that you guys get a better understanding of what players go where, who does what, so that when you see news of certain oil and gas counters, at least you know which part of the oil and gas value chain they're involved in, right? We take a look at the outlook side of the local oil and gas industry. And generally, when we discuss about the local oil and gas industry outlook, right, we always turn to what Petronas is trying to do, right? And we always have a strong focus on Petronas capex spending, because generally Petronas capex spending translates to activities, jobs and activities for a lot of these local guys. And you have to bear in mind that a lot of these local guys in Busan, Malaysia, are mostly dominated by contractors, service providers, contractors, and as well as asset providers, right? So they are very, very reliant on the local activity levels. If you look at 2022's Petronas expected capex, they have recently actually increased their capex guidance to 60 billion this year ringgit. From previously, they have actually been guiding 40 to 50 billion. Over I think the previous few weeks, they have actually upped this guidance to 60 billion ringgit. And 60 billion ringgit, if you see year on year, is actually almost double, right? 2021 to 2022, 2021, they actually do about 30 million. So 2022, we expect about 60 million. And 60 million is the highest since 2015, 2014. And remember 2015, 2014 is when oil prices were still trading at $100 per barrel. So over the last 5-6 years, 2022, we are expecting to see one of the strongest Petronas capex, right? If you see the first quarter capex spend from Petronas, it's actually still very, very underwhelming, right? Petronas actually have only spent about 7 billion in the first quarter. So 7 billion out of an expected 60 billion. That means to say the remaining 3 quarters, or especially in the second half, we are expecting that the capex numbers to come in very strong, which again translates to higher activity levels, right? If you take a look at the breakdown of Petronas spending of their capex, the biggest portion of capex spending is upstream, right? Upstream, downstream, gas. So most of it actually goes into oil and gas. C&O stands for corporate and others. So their corporate others also includes renewable energy, makes up only 11%. Most of it actually still goes to oil and gas. And even in 2022, we are expecting this narrative to stay the same, right? Again, Petronas capex expected to be backloaded in the coming quarters, especially in the second half. So in the second half, you will see a strong resurgence of local activity levels, right? If you take a look at Petronas dividends to the government, right? Because Petronas is a single shareholder company, is fully owned by the government. So every year they'll pay dividends to the government. Right. If you take a look at the committed dividends they have announced in 2022, they are expecting to pay about 25 billion ringgit dividends, which is actually essentially flat from 2021. Right. 2021 they also paid 25. 2022 they are expecting to pay 25 billion ringgit, and this is despite the fact of the high oil prices, the improved earnings outlook. So this year, Petronas is expected to actually make even more money because of the high oil prices, right? So even though the higher profits, dividend still stays the same. Petronas net cash is actually at a three-year high at 91 billion. So it has a very strong net cash position, number one. Number two, earnings outlook for this year expected to be stronger. Number three, dividend payments expected to flat year on year, even despite more cash, even despite higher earnings. So I think what this goes to show is that there is very little difficulty, in our opinion, for Petronas to meet its own capex guidance of 60 billion. So I think this 60 billion is very easy for Petronas to meet. Right. If you take a look at the global activity levels, global oil and gas activity levels, this black line here represents the offshore E&P capex globally. So again, E&P stands for exploration and production. Right, we take a look 2022, 2023, we're expected to breach past about 150 billion US dollars. And this is well above pre-pandemic levels. If you look 2017, 2018, 2019, it's about 100 to 120 billion US dollars, right? The bar charts here represents the floater projects, Fpso's, FSOs, right? And you see the amount of project awards expected in the next few years is also anticipated to increase, even surpassing pre-COVID levels. So I think the conclusion is that both globally and locally, driven by Petronas, activity levels are expected to recover in the next coming years, and even surpassing pre-COVID levels, right? Now, just to drive in, taking a deeper, more detailed look, right? Every year, Petronas actually publishes its activity outlook for the next 3 years, right? So basically, this activity outlook essentially Petronas tells everybody what are they expecting to do for over the next 3 years. This is just a quick summary, but I'll take a look with you guys one by one. Just a brief overview. Drilling rigs. So the drilling rigs in 2022, 2023, largely, especially for jackup rigs, JUR stands for jackup rigs, are expected to stay flat. And as you can recall, I mentioned Fpso is actually the biggest jackup rig provider in Malaysia. So largely to stay flat. Fpso has been actually loss-making last year. So with demand expected to stay flat, most likely they'll be loss-making also going for the next 1 or 2 years, right? You take a look at offshore fabrication. Again, the base case scenario doesn't look very promising, right? For the next 2 years, the planned, the actual activities in 2021 only came in at 6. Next 2 years, we're looking at 5 and 2. So again, the fabricator names probably not going to benefit from the Petronas activity outlook. Floater projects, there were basically none last year, and only 1 in 2022 and 1 in 2023, according to the base case. And floater providers are essentially Yinsen, MIC, Bhumi, Abanda. But then again, I think I would like to stress that our local Fpso players, our floater players, are actually very internationalized companies, right? Yinsen, MIC, Bhumi. Most of their order book actually come from the international market, so they are not very reliant on Petronas. So in this aspect, actually, they are rather unaffected by this. Now, this one is a bit more promising. You take a look at hookup and commissioning, right? We are expecting to see, according to Petronas, a jump up in demand in 2022 versus 2021 levels. And hookup and commissioning, Dayang, Charimin, Dayang is especially Dayang. It's actually the market leader within this space, right? So remember, hookup and commissioning expected to see a resurgence in 2022. Decommissioning, wells decom, right? Wells, the blue bar, also expected to see a steep increase for the next 3 years from 2021 levels. And wells decom, the company that does this is USMA, but then again, USMA does a lot of other things. So wells decommissioning is just one small part of the business. Now, offshore maintenance. Offshore maintenance, again, another positive one, expected to see a strong resurgence over the next 3 years, right? So 2022 levels expected to see a huge increase from 2021 levels and expected to stay high over the next 3 years. Again, offshore maintenance, Dayang is the key leader. So Dayang is the key market leader in MCM, offshore maintenance, as well as the hookup and commissioning, or short form as HUC, right? You look at plant turnarounds. Plant turnaround names are essentially Sabah, Dialog, MMHE, quite flattish year on year for the next 3 years. Offshore support vessels. We have offshore support vessels for production and offshore support vessels for drilling and projects. Right, drilling and projects expected to see some increase. The OSVs for production operations are expected to remain flattish, and OSV players are like Icon and Abanda. So looking through the few activities, right, that we have highlighted, the ones that seems to be the most positive, MCM and HUC, right? And I think this is a relevant point that we will touch on later, right? You take a look at the valuations of the sector, right? This red line represents the KL Energy Index, right? And KL Energy Index is basically the Busan index that lumps all the oil and gas counters together. The index is mostly market cap weighted, and it does not include Petronas counters. So your companies like PCAM, your companies like PetDat, they are not, and MISC, they're not included in this index. And if you see the movement of the index versus the movement of the underlying Brent crude oil price, right? Since mid last year, when oil prices start to go into this rally until today, the underlying KL Energy Index actually trade at a divergence. So the KL Energy Index, the oil and gas counters in general, actually trade downwards, whereas the Brent crude oil prices actually trade upwards. Now, this can be explained by a few factors, right? Again, I mentioned that the index is market cap weighted. So one big portion of why the index fell down is because of the downfall of some of the big cap names, right? Like for Sabah, like Sapura, right? And because these previously had a huge weightage because of their market cap, it dragged down the index. But more so, it's because most of the local oil and gas companies are actually contractor names. So contractor names generally have a lagged earnings effect compared to the Brent crude oil price. Generally, when crude oil prices start to rally, you will see activity levels will follow, not immediately, follow after 6 months, 12 months. So there is a lagged effect. So to date, a lot of these oil and gas contractors, right, have not started to see the earnings kick in yet. And hence why I think the share prices for a lot of these counters have not moved as well. If you take a look at the forward valuations of the PE valuations of the KL Energy Index, right? Again, as I mentioned, this is partially driven by the drag down of some of the big cap names like Sabah and Sapura. But if you look at the valuations, current valuations still trades at actually close to the lows in the first half of 2020. And if you recall, the first half of 2020 is during the oil price crash. As I mentioned in the previous chart, oil price crashed to as low as $20 per barrel Brent crude, right? And valuations from today and since then has actually not really picked up, right? Again, this is because of a lot of the oil and gas names have lagged earnings effect. Right. So the summary of all the outlook that I have discussed today. Petronas expected to ramp up capex to 60 billion ringgit this year, and this is a revision upwards from its previous guidance of 40 to 50 billion. And this is the highest since 2015 and almost doubling. Last year they did 30 million. This year they're going to do 60 million, right? First quarter capex is still very underwhelming. First quarter capex only coming at 7 billion versus 60 billion. So expect the capex to be backloaded in the coming quarters, especially in the second half. And this would drive the resurgence of local activity levels, right? And Petronas has better earnings outlook, but despite of that, they're still paying flat dividends, net cash position at a 3-year high. And hence we see very, very little challenges in Petronas in meeting their own capex guidance, right? So more likely than not, they will meet their own capex guidance. The global E&P capex is expected to pick up and even surpass pre-COVID levels in the coming years. And I think the last point that I mentioned, the KL Energy Index is still trading at a steep discount, right? Even with valuations almost as low as we've seen in the first half of 2020, right? Now, stock picks. What stocks do we favor? I think for this quarter, or more certainly in the second half, the two names that we highlight here are PChem and Dayang. And thematically, I think these two names cover both bases. PChem is a beneficiary of high crude oil prices. And I think I want to show you the next graph. You take a look at this graph, right? This graph is actually a stock price correlation to oil prices, right? So which stocks has generally been proven to be the most correlated to the movement of Brent crude. And you take a look at the first two names, PChem and Hibiscus. So PChem is actually the most correlated stock to oil prices. Hence, with us expecting oil prices to stay elevated over the next 2 years, PChem would definitely benefit, right? PChem also benefits from more stable and better margins versus its peers because of the favorable feed cost arrangement. Essentially, what this means is that they procure their feedstock at a fixed cost from Petronas. Hence, the higher oil prices would directly translate to higher earnings. Dayang, I previously mentioned, Dayang is actually the market leader within the MCM and HUC space, right? And when we look through the Petronas activity outlook, we have highlighted the MCM and HUC space to be the key winners in this round of the Petronas activity outlook for the next 3 years, right? And Dayang is a play on this. They are the market leaders. The next 2 quarters, we are expecting earnings to be strong. Dayang's vessel utilization in the first quarter actually came in at only 25%. And over the next 2 quarters, in the second and third quarter, we're actually expecting vessel utilization to go up as high as 70 to 75%. So 70-75% for the next 2 quarters versus first quarter only 25%. So these two, I think it covers both bases. One, PChem, the play on oil prices. Dayang, a play on the recovery of local activity levels. Right. Other names that we like includes Yinsen, Dialog. These are for their long-term resiliency, right? Yinsen is as I mentioned, is an FPSO player, and FPSOs generally have very, very long contract tenures, right? 15, 20, 25, 30-year contract, which makes Yinsen's earnings base very, very resilient, right? Dialog, they do the oil storage tankers in Pengerang, which has also long-term contracts, which again makes their earnings very, very defensive. So if you are looking for long-term resiliency within the oil and gas space, we recommend these two names. Recovery play is USMA. Now USMA's share price, right, have been bashed down quite severely over the past few months, right? And we believe that this makes its risk to reward ratio very, very favorable, right? USMA have been actually guiding a 5-year outlook whereby they expect their revenue to actually reach 1.5 billion ringgit over the next 5 years. And this is 1.5 billion ringgit is almost triple of what they do today, right? And they are expecting 40% of this revenue to come from solar non-oil and gas solar ventures. So they are also trying to venture into RE, which is another high growth sector. So given their very ambitious target, if they can meet their targets, and the low share price, which gives very, very favorable risk to reward ratio, USMA can be a recovery play as well. And we would like to highlight another proxy for oil prices, right? Hibiscus. Again, Hibiscus is a pure play E&P player. So E&P stands for exploration production. They are essentially owners of the oil field. So whatever oil price is what the oil price that they sell from the oil field, that directly translates to their revenue and to their earnings. Again, if you take a look at this graph, they are one of the most correlated stocks to oil prices, right? And I think with that, I conclude my session, right? Shane?
Yes, thank you so much, Stephen, for sharing with us the Kenanga oil and gas sector outlook session. All right, so I think many of us here have learned a great deal about the outlook that you projected. So if you have any questions you want to ask our speaker today, please write them in the Q&A box here. Now, of course, those questions in relation to geopolitics or politics, right? You know, may not be able to address adequately, lah. Okay, I've seen a lot of question here. Okay, let's do the first question here. Is Hibiscus having tax issues with the Sarawak state government?
No comment.
Okay, can't comment. Okay. Okay. So the next question is, I think a lot of questions that they have written here have been addressed. So I'm not sure. Let me filter a bit more. What is your view on Coastal as a FPSO player?
Right. Coastal, they have been guiding that they want to actually venture into the FPSO, and they have been guiding for quite some time already. I think over the last few years, right, Coastal, you see they actually gradually transformed the company. They started off as a shipbuilder, right? And now they are very much an infrastructure, gas-based infrastructure company. They have not actually made any inroads into the FPSO space, although they are trying. They've always been guiding that is one of their ambitions. But you know, they say that they will need to find partners, you know. And I think partners is very important, right? Because you trying to venture into a new space, right? The lack of expertise, lack of familiarity, you definitely need to find a strong partner that can carry you into a new field, especially in FPSO, right? The FPSO market actually is very promising. I think let me just show you back the slide I have just now. Yeah, here. Right, the FPSO market is actually very promising. A lot of the FPSO projects we see over the last 1, 2, 3, 4 years, right? There have been a shortage of FPSO companies. So the bidders for new FPSO tenders actually have been shrinking until to the point where last year, we see a lot of projects actually have single source. Single source meaning to say that the oil majors put out a bid for an FPSO contract, and we only see probably one bidder, right? So there is a lot of opportunity in the FPSO market with very little competition. So the FPSO market is actually very promising. What Coastal, I think, in my opinion, what they need to do is they need to find a partner with the relevant expertise to bring them into the sector. And I think if someone wants to partner you, you have to put something on the table. So you have to contribute something as well, right? Yeah. But in this moment in time, they have not made any inroads into the FPSO market. But that is their ambition.
Okay. The next question is by Tony. Why has Bhumi Abanda underperformed in Busan, Malaysia?
You take a look over the last few years, right? Bhumi Armada 3-4 years ago, they actually have been suffering from huge borrowings issue. The borrowings came from corporate debt that they incurred when they actually bought over a lot of all these OSV vessels back in when the previous boom of oil prices, 2012, 2013, right? They bought a lot of all these OSV vessels. And because of that, they incurred a lot of corporate debt. So then again, after 2014, the oil price crashed. So they're stuck with all these vessels that the value of these vessels have deteriorated significantly. They're stuck with the huge corporate debt. So over the last few years, they have been suffering from borrowings issue. Then they have also secured this new, secured this contract, the Armada Kraken FPSO contract. And the Armada Kraken FPSO contract was also faced with a lot of operational issues even before it started. So even the startup also managed the startup also got delayed. They also got penalized by the clients. And I think that also dragged down a lot of their earnings the last few years, right? Before 2020, let's say 2018, 2017, 2018. The slow startup of the Kraken, and Kraken is their biggest project to date that they have taken on. The slow startup to Kraken, the high debt that they have inherited over the yesteryears, basically had bogged them down. And if you look, you compare Bhumi Armada against another FPSO player, for example, like Yinsen. Yinsen doesn't have that huge of a corporate debt, right? Most of Yinsen's debt are actually project finance. Project finance meaning to say that the borrowings are actually tied to the long-term FPSO contracts, and they are non-recourse, guaranteed by the underlying asset, guaranteed by the cash flow of the long-term contracts. So Yinsen's balance sheet in this example, Yinsen's balance sheet is actually much more concrete compared to Bhumi's, right? So the last few years, I think, since 2019, 2020, they have managed to, Bhumi Armada managed to secure an extension of their loan. They managed to refinance the loans. The bankers basically gave them an extension. And slowly they have managed to dispose of all their OSV vessels. Not all, but most of it have already been disposed. They recoup a lot of cash back. The last few years, the Kraken project also have slowly been improving. And that has also led to, like, the last two years or so, cash flows to have improved. So now Bhumi Armada has essentially emerged from the mud where they see over the last few years, right? And I think going forward, management has been guiding that, given that they have improved their balance sheet, they have improved their cash flows, they are now starting to look at tender opportunities, because as I mentioned, the FPSO market is actually very, very attractive. So they also want a piece of it. Previously, they could not participate because of their balance sheet, because of all these borrowings, because of them very busy with all the operational issues with Kraken. But now, since all of these problems have more or less been solved, of course, the borrowings are still there. Borrowings are still there, but have gradually have gone down a lot over the yesteryears. And so now they're actually eyeing expansion, so tendering for new jobs. And I think we can see, if you read some of the industry news, they have actually been tendering as well. Yeah.
Okay, thanks, Stephen, for clarifying. Okay, the next question is by Jane. Are those upstream companies are those upstream companies generate better profit than the midstream and downstream companies?
Wow, it's a very because it's a very loaded question, right? Because like upstream, as you look at this graph, right, upstream covers a lot of value chains. Downstream covers a lot of value chains. So if you compare the entirety of upstream versus the entirety of downstream, I think the answer is it depends, right? Of course, generally, just a broad generalization, you see a lot of these upstream names have actually struggled over the years, right? Names like Sapura, right? A lot of the OSV players, because these are asset-based players, right? They buy over the yesteryears. They have to own these assets. They have to incur debt, own these OSVs, and because of that, their balance sheet has been brought down. And when the oil price crash, they're stuck with all these borrowings. So generally, names like Alam, names like Perdana, names like Icon, all these names, OSV players, right? All these asset-based, as well as Sapura, Velasco as well, under drilling, where's drilling? Okay, so Velasco as well. All these names have actually, over the last 5-6 years, have undergone some form of fundraising, some form of corporate debt restructuring, right? Because it has been proven very, very difficult, because the nature of the business is very asset-based, right? Downstream, in general, not in specific, in general, tends to be a bit more resilient, right? The nature of the business. You look at downstream, it includes players like PetDeck. Like, for example, PetDeck, they do the distributing and marketing. So essentially, it's your petrol stations, right? So regardless of what oil prices, we also need to pump petrol. PChem, LC Titan, petrochemical players, regardless of what oil prices, we also need to use petrochemicals, right, for our daily use. Dialog, right, their offshore storage, their onshore storage facilities, long-term contracts, also generally very, very stable. So yeah, I think just generalizing, downstream over the last few years tends to have a bit more resiliency in terms of their earnings compared to upstream, historically. Of course, this is very, very, very generalizing, a broad question.
Okay, thanks, Stephen, for sharing your view. Since you mentioned about Sapura, so Kai Yong has a questions. If one day Petronas build out Sapura Energy, so what do you think is the effect to the market?
It's a very, very good question. My opinion on Sapura, right? You see, Sapura has just recently been classified as PN17, right? Their auditors have actually expressed material uncertainty over its going concern, meaning to say that the auditors themselves don't believe that your business can continue running. Sapura's debt is as high as about 10-11 billion ringgit, and all of it, if you look at their balance sheet, all of the borrowings are actually classified as short-term debt, right? Last year, the fourth quarter of last year, they took a massive impairment, essentially wrote down 99% of their book value, right? So for all intents and purposes, their book value is almost zero. Their debt is huge. In the balance sheet, all classified as short-term. PN17, uncertainty over its going concern. My view on Sapura is that it definitely needs some sort of white knight to come in, either through banks giving a haircut on the borrowings, the huge borrowings, Petronas or MOF or one of the GLCs, PNB or whoever, come in and build them up. Because if not, I think if you leave Sapura, just to run its natural course, run its natural business, just take its own natural course, it's quite difficult. It's very, very challenging. Whether or not Petronas wants to do it, I think it's a separate matter. I think it's quite debatable, whether Petronas wants to do it or not. Sapura's market cap now is about 600 something million. And as I mentioned, 10 billion ringgit debt is not a small amount. So whether or not someone out there has that huge of a money to give out, not just have the capability, have the intention to build them out also, right? Sapura, even if Sapura going to the bankers to loan money, right, for their working capital also is very, very hard. They actually have no access to credit facilities. And let's say even if Sapura does a rights issue at this moment, it's very hard to say who is willing to underwrite equity fundraising as well. So it's very, very hard. I think they definitely need some sort of white knight to come.
Okay, thanks, Stephen, for sharing about your view on Sapura. Okay, so what would be the impact of recession and rising interest rate on your outlook projection on the oil and gas counter? This question is by Eric Go.
Yeah. I think it's a very good question. Generally, high interest rates tends to curb inflation, right? High interest rates, strong US dollar tends to actually lead to lower oil prices. That is generally right. So you're seeing the Fed raising interest rates, curbing inflation, stronger US dollar generally leads to lower oil prices. But the next 2 years, because of the Russia-Ukraine conflict, right? I think more or less the Russian-Ukraine conflict, the drop in global supply is going to definitely offset this. If you ask analysts across the board, let's say second half of last year, right, before the Russian-Ukraine conflict actually emerged, right, 8 out of 10 industry experts would actually predict 2022, 2023 level oil prices to actually come off because of the Fed increasing interest rates, because of the outlook of stronger US dollars. But because of the Russian-Ukraine war, the supply side constraint, generally that is more than enough to offset the rising interest rates.
Okay. Thanks, Stephen. The next question is, why Fpso cannot perform even though jack-up rigs is going to be in great demand?
Jack-up rigs, if you recall my slide, the demand for jack-up rigs actually is not going to be great, right, over the next 2 years. You look at this, the green bar, jack-up rig, JUR, right, for the next 2 years actually expected to stay flat to 2021 levels. And 2021, Fpso is still loss-making, right? So loss-making in 2021, the demand actually is expected to stay flat. More, the probability is more often than not, I think they are going to stay loss-making in 2022 and 2023 as well. What Fpso needs to do, I think, because currently they're still very, very local based, very, very local centric, very, very reliant on Petronas. So what they need to do is improve its competitiveness, try to bid for projects overseas, try to bid for contracts overseas, right? So that the Petronas flattish demand for jack-up rigs for over the next 2 years, at least they're not too affected by this. I think that's what they need to do. But at this moment in time, they are very, very local centric. So the demand is actually expected to stay flat over the next 2 years.
Okay. How about Dialog? What is your outlook on this? The share price seems to be on downtrend, even though crude is on the upside. So this question is by Ping Pike.
Yeah. Dialog, I think, as I mentioned, Dialog is one of the long-term resiliency stock, right? The share price has not been doing very great, I admit. I think partially why the share price has taken a hit, right? is because of the delay in the development of Pengerang, especially Pengerang Phase 3, right? When they first started this entire Pengerang project, I think back in 2014, 2015, you wouldn't have expected, by 2022, Pengerang, the Pengerang will still be under development. Pengerang Phase 3 has not been up yet, right? The last 2 years have actually delayed a lot of talks on trying to secure clients to take up the Pengerang Phase 3, because clients actually need to go physically on site to view the land, to view the facilities, the surrounding facilities, right, before they can make a decision to invest in Pengerang Phase 3. So I think that plus their downstream side also have suffered lower activities over the last 2 years. That has actually contributed to the weakness in share prices. Going forward, with the reopening of borders, with Petronas, their PIC stands for Pengerang Integrated Complex, expected to start up in the second half of this year. Hopefully, that would drive the talks that Dialog is having with potential clients now. So new clients to come in Pengerang Phase 3. So the Pengerang Phase 3 is actually one of the biggest catalysts for Dialog's share price. And I think over the next 1 or 2 years, I expect they should be able to secure some sort of agreement with some new clients for the development of Phase 3, and hopefully that will act as a catalyst for share price as well.
Okay. Only would like to ask, we have heard some of the great prospect about the oil and gas going forward. What are some of the risks that we need to be aware of?
Yeah. Risk is, I think the biggest risk is the oil price crash. And oil price crash, very, very dependent on geopolitical aspects, right? If tomorrow, let's say Russia decides to pull out from Ukraine, the oil price outlook will definitely be different. The other risk is that, if China lockdown continues to tighten going into 2023, because again, the oil price outlook is dependent on China's resurgence in 2023 as they gradually open up borders, right? If that is not the case, if the COVID in China continues to get worse and worse, continues to lock down in 2023, that impacts oil demand. Definitely, some of the oil projections would have to be adjusted as well.
Okay. Thanks for sharing your view about the downside risk. Now, should we be afraid to invest in the oil and gas sector post Sabah dynamic case?
Actually, I'll answer yes, with a caveat. A lot of the oil and gas names are fundamentally still very depressed. So their fundamentals are still very depressed, right, compared to yesteryears, because the downfall, the oil price crash. There's 2 oil price crashes over the last 10 years, right? And that actually has deteriorated a lot of the company's fundamentals, right? A lot of companies, you look at, like as I mentioned, upstream players, a lot of them actually over the last 5 years have gone through some form of fundraising, some form of debt restructuring, some form of rights issue, right? So their balance sheet, their fundamentals, a lot of the names actually are still very, very depressed. I wouldn't use the word scared. It's just that investing in the oil and gas space, you have to be very, very selective of your names, because a lot of the names, as I mentioned, still suffering from depressed fundamentals. You have to invest in names that have, at least good balance sheet, good earnings outlook, right? Something that you have a visible outlook on, right? So being selective is, I think, one of the biggest criteria in investing in oil and gas. And the stock picks that I mentioned, these here also, I think it fits into those criteria. The names that I mentioned all here have fairly healthy balance sheet with some form of earnings deliverability as well. So none of these names here, as I mentioned, are like long-term loss-making, long-term in high debt kind of companies.
Your team did adequate research and thorough research, right? Okay. Anthony would like to ask in reference to one of your stock picks here, which is USMA. Okay, now USMA TP has been revised down by Kenanga from 68 cent to 54 cent. Why is that?
I think one of the black mark on USMA is its earnings deliverability, right? I mean, over the long term, as I mentioned, they do have this 5-year roadmap, very ambitious, achieving 1.5 billion ringgit revenue by 2026. 5 years. But the last few quarters, right, because of COVID, because of project delays, because of cost recognition of some of their projects, the earnings actually did not manage to meet expectations, right? And I think you have to be a bit more patient with USMA because quarter-on-quarter earnings sometimes tends to fluctuate, right? And a lot of the quarters, they actually have underperformed or at least have not met earnings expectations. And that I think prompted one of the reasons on why we slightly tweaked the TP downwards. But then again, with the current TP, that there is still quite some upside. And as I mentioned, I think USMA, the upside to downside risk is quite favorable. I think analysts generally have been very, very conservative now with their earnings forecast. And if there is a chance that USMA can outperform, some of these earnings expectation, definitely is one of the re-rating catalysts. Of course, longer term, the re-rating catalyst is them managing to deliver their long-term targets, achieving 1.5 billion ringgit revenue in 5 years.
Is there a reason why analysts now are more conservative on the earnings forecast? Is it due to a bad market sentiment or a bad economy forecast?
Yeah. I think as I mentioned previously, I think USMA, because of the timing of them recognizing their contract revenue and their contract cost, right? The last several quarters they have under-delivered in earnings, slightly missing analyst expectations in terms of earnings.
Okay. Now, the next question is by Chuan Yu Saw. Will the strong US dollar benefit the Malaysia oil companies?
Strong US dollar benefit the Malaysian oil companies? Generally, yes, because a lot of Malaysian oil and gas companies are essentially dollar in, dollar out companies, right? Like Inson, like Bhumi, like MIC. Where is the list? All right. Generally, a lot of these names like Inson, Bhumi, MIC, these are Fpso players. Again, very, very internationalized. They're essentially dollar in, dollar out companies. So they charge their revenue by US dollars, right? Their cost is also by US dollars. So when you translate back, when you report the translated earnings to ringgit, definitely you see an earnings impact, right? Sapura, although yes, PN17, but most of their order book is also overseas. Venesto, as I mentioned, they mostly do local market drilling rigs, but actually the quotation of price that they give to their clients, they actually quote in US dollars. Even though they operate in Malaysia, they actually quote in US dollars. So when US dollars, the USD is higher, generally it translates to higher earnings as well.
Okay. All right. The next question is by Thea. Is Delium promising as well?
Delium, they are more onto well services, right? So they do some of this slip line wells. They do a little bit of MCM, like what Dayang is doing, but most of it is well services, right? Generally, that segment is expected to see an improvement over the next couple of quarters. Number one is also because of, like I mentioned, the recovery of activity levels locally. Number two is also because them, alongside with all the other industry players in that space, the last 2 years actually have saw logistical disruptions, because of the COVID lockdown. So they are unable to execute a lot of their contracts. So with the borders reopening, generally the outlook should be better compared to the last 2-3 years.
Okay. The next question is by John. Can you confirm that it is a market practice that oil majors who award and sign FPSO contract for long tenure can terminate unilaterally by serving a 6-month termination notice with little compensation?
No, that's not the general practice.
That's not general practice.
And generally, an FPSO contract should have some sort of termination clause. So if either party wants to terminate, right, you have to pay a huge compensation one, right? And as I mentioned, if that is the case, if there is no termination clause, right, I give you 6 months notice and I can just straight away terminate, right? Nobody wants to do FPSO business really, because as I mentioned, FPSO business is actually a huge capex business. As like earlier mentioned, some of these FPSOs go up to $1 billion, $2 billion, right? So it's actually a huge financial risk that you're undertaking to supply an FPSO to a client. And FPSOs most of the time are purpose-built one. So that means if a client awards you an FPSO contract, it's not to say that it's not like renting a car. The FPSO is purpose-built for your oil field to meet your specifications, right? So I built this FPSO over the last 2, 3, 4 years just for you, right? So that you can use it for the next 20, 25 years or so. And if you just terminate without termination clause, then it's a very, very bad business to be in. So generally, no, that is not the market practice.
Yeah, I learned that. I learned that after they finish the tenure, which is, when they're done with the exploration and production, so they will decommission the FPSO, right?
Yes. Yeah. So FPSOs most of the time are converted tanker vessels. So like VLCC vessels. That have been reconverted into FPSOs. So if an FPSO, after it fulfills the length of its contract, if it is still in good condition, it's a big if, because as I mentioned, after 15 years, 20 years, it could be as good as scrap. But if it's still in good condition, if you want to redeploy the asset into another oil field, you have to do another round of construction, another round of conversion, because again, FPSO is very purpose-built.
Okay, so the owner customize it for the clients.
Yeah.
All right. So what is your view on MMHE? That's by David.
Yeah, MMHE it's actually a loss-making company.
So that's why it's not on your stock pick.
Yeah, it's a loss-making company. I think it has been steady track record of loss making. Very, very, very hard for them to turn around, I feel. They, I think, need to do, or at least need to win a lot of projects. And I think it's also partially because of the nature of the business, right? The nature of the business requires them to how they recognize their earnings is essentially a lot of the earnings recognition is actually backloaded towards the tail end of a construction contract. So let's say a construction contract is, let's say, 3 years. A lot of the 3-year contract earnings, right, will be recognized actually in the last 6 months or last 12 months of the contract, right? So for the first 2 years, you are essentially loss-making on a P&L basis. You're actually loss-making from the contract, and then third year you suddenly see a jump in profits. And I think it's partially because of this sort of business model, right? It's very, very hard for them to see sustained earnings, right? And in order to see sustained earnings, meaning to say that you have to consistently have new contracts coming in, consistently have order book replenishment coming in. Every year you deliver new projects. Every year you deliver new contracts, right, to the clients before you can see sustainable earnings, and for that to happen it is quite difficult, right? You look at the offshore fabrication outlook by Petronas, right? It's expected to decline over the next 2 years. So, yeah, I think it's a bit difficult to see any catalyst now from MMG.
Okay. Can you explain about what caused LC Titan share price not moving up? This is question by Yu Li.
Yep. It's a very good question. Right. Let me see where's the chart. Okay. LC Titan, right? Main peer is PChem, right? These two are the biggest petrochemical companies in Busan, Malaysia. What's the biggest difference between PChem and LC Titan? PChem, they get their feedstock from Petronas at a fixed price. They are gas-based. LC Titan is naphtha-based. Naphtha is a product of oil. So LC Titan naphtha-based, PChem gas-based. So their raw mat is gas. One is raw mat is oil. PChem has, because being a Petronas company, they actually have a favorable arrangement with Petronas where they can actually secure their feedstock at a fixed price, right? So their earnings essentially is driven mostly by the petrochemical product prices, or ASPs, and average selling price, right? As long as petrochemical prices go up, because their cost is fixed, their input cost is fixed, petrochemical prices go up, they make more earnings. LC Titan is a bit more challenging because they don't have any favorable arrangement, right? Their feed cost is also based on market fluctuations So generally based on oil prices, right? Because it's naphtha based, so it mimics oil prices. So they suffer from the margin spread fluctuation, right? So the margin spread fluctuation between the petrochemical prices versus their naphtha or the naphtha feed cost price or the underlying oil prices. So if oil prices rise up faster than the petrochemical prices, they actually see a squeeze in margins. So sometimes you see, hey, how come oil prices go up? LC Titan actually make lesser money, right? It's because of this. Oil prices go up, their cost is higher. But if the petrochemical prices don't go up in tandem with the higher oil prices, then their margins will squeeze. So you see the earnings comparison between PChem and LC Titan, right? LC Titan last few quarters not making a lot of money because of the high feed cost, whereas PChem, completely different story, right? They're making huge profits.
All right, thanks for making this distinction. So we got to observe the spread between their feed cost and oil price.
Yeah.
All right. Now FPSO companies are usually highly leveraged, and as interest rate goes up, right, will FPSO players such as Yinsen face significantly higher financial burden?
Yeah, that's a very good question. Generally, the answer is no. Because yes, higher interest rate, but because a lot of these FPSO contracts are very long-term ones. So the FPSO companies, right, will favor visibility or favor stability. So what they do is they tend to do swaps, interest rate swaps. So whatever floating portion of their borrowings, they'll swap out for fixed rates when they undertake a new contract. So they are quite protected in that regard. The only exposure that they might have in interest rates is the corporate debt side, means not the project financing, not the non-recourse type of loan, the working capital type of loan, right? Sometimes you need working capital to build a new vessel before you charter it to your clients. That one you may see you may see some impact from interest rates. But in general, the reason why FPSO players are very highly geared is because of these project financings, right? As I mentioned, $1 billion, $2 billion US sort of projects. That's why the gearing is high, and it's all project finance. Most of it is actually swapped.
Well, thank you so much for doing this very engaging question and answer session with us. All right, so I think we shall conclude this Q&A session with, I think all of us here have learned a great deal from this session. Apology if we can't take, I see there are a lot of questions on politics and geopolitical questions, so we are unable to address those questions. So let me proceed to share my screen here, Stephen.
Right.
All right, so our next session is on this title, Live Chat with Nescon Berhad, Twin Engines for Growth. So on the 14th of July, which is a Thursday, so we will be featuring the managing director of Nescon to talk about their business. Okay, so this is a session where we will feature senior management of a PLC, publicly listed company, to join us to talk about their business. All right, so if you want to join us, do register for this. I've just given you the registration link. You may register on the chat box that I've just given you. All right, so for those of you who haven't had a Kenanga share trading account, you may hit today's website, which is www.kentrade.com.my/open-account-form. So once you key in your interest, then Kenanga will arrange a friendly dealer representative to cater to your needs and requests to open a share trading account with Kenanga. Now, if you haven't joined Kenanga Trade to Win Telegram channel, you may also join this link. I've also given you the link in the chat box. So you may join this link so that you can get trading ideas. Okay, so the licensed investment advisor posting on the Trade to Win Telegram channel on the everyday basis to share you some of the trade ideas that you may have, and then what are the TP, what is the SL, and so on. So you may join the Telegram channel and get more trading ideas. All right. So thanks everyone for joining this session brought to you by Kenanga Investment Bank. My name is Shen Chu. I'm signing off now. So hope to see you all in our next Can Trade webinar. Thank you so much, Stephen.
All right. Thank you, everyone. Bye-bye.
Bye, everyone.